welcome to the deep dive. So you're pouring your heart into your California home-based food business, making amazing things. That's the passion, right?
Absolutely. That's where the joy is.
But let's be honest, there's this other side. The taxes, the admin stuff. It might not taste as good, but getting it right is so crucial for sticking around and avoiding, major headaches later.
Definitely. It's
Yeah.
like the essential structure underneath the creative part. It needs to be solid.
Yeah, exactly. So for this deep dive, we've pulled together key info on navigating taxes, specifically for California Cottage Food Operations CFOs. We're looking at both state and federal stuff.
Trying to streamline it, basically.
Right. Think of this as your guide to what really matters. Our mission today is pretty straightforward. Just extract the must-know info about tax responsibilities for you, the California home food entrepreneur. Give you a clear, actionable picture.
Sounds good. Where should we start?
Okay, let's jump right in with business structure. That seems like the foundation for how taxes work. Yeah.
That's the perfect place to start. So, for most CFOs, the reality is you're likely operating as a sole proprietorship. If you didn't actively set up something else, that's probably you.
Kind of the default.
Exactly. And it's interesting how that basic choice really dictates your tax path.
Okay, so federally, if I'm a sole proprietor, what are the main tax things I need on my radar?
Federally, the big one is Schedule C. That's part of your main Form 1040 tax return.
Right.
On Schedule C, you list all your business income, but also all your deductible expenses. That calculates your profit or loss.
Okay.
And crucially, don't forget self-employment tax. Since you're your own boss, you pay Social Security and Medicare yourself. That's handled on Schedule SE.
Schedule SE. So that's on top of regular income tax. Good to factor in.
Definitely need to plan for it.
And what about California? Our state taxes, how does that work for a sole proprietor?
It's pretty similar in concept. You'll file a state tax return with the California Franchise Tax Board, the FTB.
FTB, right.
And you report your business income there, too, as
Right.
part of your overall state income. Now, it's probably worth mentioning the LLC.
Yeah, the limited liability company. You hear that acronym thrown around a lot for small businesses. What's the main appeal there for someone baking cookies at home?
Well, the primary draw is liability protection. It can create a separation between your personal assets, like your house, and your business debts. If something goes wrong,
Okay, that sounds potentially useful, but I hear there are costs involved.
There are, and this is really important for small-scale food folks. Setting one up involves fees, maybe around $99 for a service, plus an $85 state filing fee, maybe a bit for shipping docs.
Okay, initial setup costs.
But the big one, the ongoing one, is the annual California franchise tax. It's a minimum of $800 every single year.
Wow, $800 minimum, even if you don't make much profit that year.
Even if you make zero profit, or even a loss, you still owe that $800 minimum franchise tax to California just for being an LLC.
Oof, that's a lot of flour and sugar. That could be a significant chunk of change for a small home business.
It really can be. So yes, there's potential liability protection, but you absolutely have to weigh that against this recurring $800 cost, especially when you're just starting out.
That annual fee definitely needs careful thought in your planning. Okay, structure covered. Let's shift gears to sales tax. This feels like a tricky area for food businesses. First off, we need a seller's permit, no question.
Yes, absolutely. Getting a seller's permit from the California Department of Tax and Fee Administration, the CDTFA, is legally required if you're selling food products here, period.
Okay, CDTFA, got it. Permit secured. Now, when do we actually charge sales tax? This seems like where the confusion comes in.
It really does. The key thing is what you're selling and how it's meant to be eaten. Generally speaking, if you're selling cold, prepackaged food that someone's taking away to eat later, think decorated cookies, granola bags, jam jars, that's usually not taxable.
Okay, so my packaged cookies for the farmer's market are probably non-taxable. What is taxable then?
Typically things like hot prepared foods, if you were selling hot soup, for example, or food that's consumed on site where you sell it.
Okay.
And another wrinkle. Sometimes, if you sell at an event like a festival that charges an admission fee, your food sales might become taxable even if they're cold and prepackaged.
Really? Even the cookies?
It can depend on the specifics of the event. The CDTFA has guides with examples, and honestly, it's worth looking those up for your specific situation because the nuances matter.
Definitely sounds like homework is needed there.
Right.
Okay, but here's a really important point I think we need to hit. What if all my sales are non-taxable? Say I only sell those packaged cookies. Am I done with the CDTFA then?
No. And this trips up so many new businesses. Even if 100% of your sales are non-taxable, you are still legally required to file regular sales tax returns with the CDTFA.
Even if I owe zero tax?
Even if you owe zero. You file the return, report your total gross sales, and then you claim the exemptions for your non-taxable sales. If you don't file those returns, even zero due returns, they can hit you with penalties later.
Wow, okay. Filing is mandatory, regardless of owing. That's a crucial takeaway. So meticulous records are vital here.
Non-negotiable.
All right. Now, we touched on income tax earlier, federal and state. Let's just circle back for a bit more clarity. Federally, we're talking Schedule C and Schedule SE again, right?
Exactly. Schedule C, that's where you list your business income, subtract all your allowable business expenses, and arrive at your net profit or loss.
Okay.
That net profit number then goes on to your main Form 1040, and that's what you pay federal income tax on.
Got it.
And then Schedule SE takes that same net profit figure to calculate your self-employment taxes, the Social Security and Medicare part we mentioned.
Right, SE for self-employment.
Yeah.
Makes sense. And for California state income tax.
You'll file your California state income tax return with the FTB, the Franchise Tax Board. And that return needs to include the income from your cottage food business, too. Generally, how you report it federally lines up with how you record it on the state level.
Okay, reporting income.
Yeah.
Check. Now, the fun part, maybe, deductions. What business expenses can a California home-based food business actually write off to lower that taxable income?
Ah, yes. Everyone loves deductions. This is where good record keeping really shines. You can deduct expenses that are ordinary and necessary for your business.
Okay, like what?
Well, the obvious ones for food are your ingredients, right? Flour, sugar, spices, chocolate, and also packaging materials. Boxes, bags, labels, jars, anything tangible that goes into making and selling your product.
Makes total sense. What about using our home kitchen? Can we deduct home office type expenses?
Yes, potentially, but there's a very important rule here: exclusivity. The part of your home you claim must be used exclusively and regularly for your business?
Exclusively, so not the corner of the kitchen table where the kids also do homework.
Exactly not. It needs to be a dedicated space, like a specific room, or even just a clearly defined part of a room used only for your business tasks, maybe storing inventory, doing bookkeeping, packaging orders.
Okay. And how do you figure out the deduction?
It's usually based on the percentage of your home's total square footage that this exclusive business area occupies. If your dedicated office space is 10% of your home, you can generally deduct 10% of relevant home costs, like mortgage interest or rent and utilities.
Utilities, like electricity, gas, internet. We need those for the business, right? Ordering supplies online, maybe running a website.
For sure. You can deduct the business portion of those utility bills. So again, if your business use percentage is 10%, you could potentially deduct 10% of your electricity bill, your gas bill, your internet bill.
But just the proportion related to business use.
Precisely. You need to be able to justify that allocation if asked.
Okay. What about driving? Picking up supplies, maybe doing local deliveries. Can we deduct car expenses?
Yes. Business use of your vehicle is deductible. You generally have two ways to do it.
Okay.
One is the standard mileage rate. The IRS sets a rate per mile for business driving. For this, you must keep a detailed log of your business. Miles, dates, purpose, mileage.
A logbook.
Or you can track your actual vehicle expenses, gas, oil changes, repairs, insurance, registration, and then deduct the percentage of those costs that corresponds to your business use percentage for the car.
Got it. Actual expenses versus the standard mileage rate. Need to see which makes more sense.
And keep records either way.
This all sounds great for lowering taxes, but it feels like there's a big but coming.
There is. The absolute number one, cannot stress this enough, rule for deductions is documentation. You need proof. Keep detailed records and receipts for every single expense you plan to deduct.
So no receipt, no deduction.
Pretty much. Or at least if the IRS or FTB audits you and you can't provide proof for a deduction, they can disallow it and you'll owe more tax, plus potentially penalties and interest. So save everything. Invoices, bank statements showing the expense, credit card slips, mileage logs. Keep it organized.
That's crystal clear advice. So beyond just not throwing receipts away, what other key record-keeping or compliance habits could a CFO really adopt?
Okay, first, get organized. Don't just have a shoebox. Use folders, or better yet, digital scanning and storage. Whatever system works for you, use it consistently. Second, and I really recommend this, Open a separate business bank account and use it only for business income and expenses. Don't mix personal and business funds.
Why is that so important?
Oh, it makes bookkeeping and tax prep infinitely easier. Trying to sort out which grocery trip included business ingredients versus personal snacks months later. It's a nightmare. Separation keeps things clean and clear.
Yeah, I can definitely see that saving a ton of headaches. Good tip.
And third, remember our sales tax talk. Keep accurately tracking all your sales. Make sure you know which ones were taxable and which weren't, so your CDTFA filings are correct.
Right. Tracking taxable versus non-taxable. Okay, this has been a lot, but super helpful. Let's try a quick recap of the main points just to solidify things.
Good idea. So number one, your business structure, probably sole proprietor starting out, dictates how you file federal Schedule SE and state FTB income taxes. Number two, seller's permit from CDTFA is mandatory for selling food. And you must understand the difference between taxable sales, like hot food, and non-taxable sales, like cold, prepackaged. Number three, even if all sales are non-taxable, you still have to file those sales tax returns with CDTFA, reporting gross sales and claiming exemptions.
Crucial point.
Number four, you can deduct legitimate business expenses, ingredients, packaging, the exclusive portion of home office space costs, the business portion of utilities and vehicle use.
Right.
But number five, you absolutely must have detailed records and receipts to back up every single deduction. No proof, potentially no deduction.
Got it.
And finally, number six, good record keeping is foundational. Separate business finances, track all your sales accurately. It makes everything else manageable.
Fantastic summary. That really distills it down. Now, if someone listening wants to dive even deeper into specific rules, where are the best places to look?
Definitely go to the official sources. For sales tax specifics in California, the CDTFA website has guides, including one for home-based businesses. It's very helpful.
Okay, CDTFA for sales tax.
For California state income tax questions, go straight to the Franchise Tax Board FTB website. They have resources for small businesses.
FTB for state income tax.
And for all the federal tax stuff, Schedule C, Schedule SE, general business deductions, the IRS website has a great section called the Small Business and Self-Employed Tax Center. Loads of info there.
Perfect. CDTFA, FTB, IRS. We'll make sure to link those. So look, tackling taxes for your home food business might feel a bit intimidating at first.
It often does.
But honestly, getting a handle on these core ideas is a huge step towards building something sustainable, something that can really grow.
Absolutely. And remember, those official resources are there to help guide you. You're not completely on your own.
So maybe here's a final thought for you listening. What's one record-keeping habit you could start? Or maybe improve, like today? Is it finally setting up that separate bank account? Or maybe just committing to scanning receipts weekly instead of letting them pile up?
Taking that one proactive step now.
Exactly. Because getting organized proactively can save you so much time and stress, and maybe even some money, when tax time actually arrives. Thanks for taking this deep dive with us.